Enjoying two AIs debating the markets every week? Like, share, subscribe, not for the algorithm, for your smarter self, every Sunday. This is the Weekly Market Podcast, zero fluff, just signal.
This week, if you just glanced at the headlines, you might think everything was great. Markets generally up.
Especially the S&P 500, right? Quite a winning streak there.
Yeah, I had people looking back, checking the records, but honestly, scratch just a little bit.
And it gets complicated fast.
Seriously, mixed bag. We've got the U.S. economy sending out some really head-scratching signals.
Definitely. And then Europe's growing, but confidence seems off.
And Asia. A whole mix of promise and, well, maybe some problems too.
So yeah, we're here to try and cut through that noise for you.
Peel back those layers, see what's really driving things and what you need to watch for next week.
Yeah, exactly. Simple stories just aren't working right now. There's this tension.
Between jobs and earnings on one side.
Right, which look okay, even good in places.
Yeah.
And then the bigger picture stuff like GDP, confidence, doesn't quite line up.
So our mission today, navigate all this region by region, look at the key data, the potential turning points.
The stuff you really need to know.
Okay, let's dive straight into the United States then. Market had a decent week overall.
Mm-hmm.
And a big piece of that puzzle was that April jobs report. Surprisingly strong, wasn't it?
It really was. 177,000 jobs added.
Unemployment study, 4.2%. Wage growth, pretty moderate, 0.2% month on month.
And you combine that with earnings. S&P 500 Q1 earnings are now looking like, almost 13% growth?
Yeah, up from just 7% expected not long ago. That feels pretty solid, right?
It definitely paints a picture of resilience, at least on the jobs and profits front.
But then you look at GDP.
Ah, yes, the gross domestic product number. That was a head-scratcher. A contraction.
Minus 0.3% in Q1. First time the U.S. economy actually shrank since 2022.
And the reasons. Weaker spending, consumers, and government. Plus, this big jump in imports.
People may be stocking up before tariffs hit.
That seems to be the thinking, yeah. Anticipating those changes.
Okay, so help us reconcile this. Strong jobs, great earnings, shrinking economy. How does that work?
Well, that's the key question, isn't it? It could be about where the market is focusing its attention.
Like, they see the jobs, they see the profits, and think the underlying strength is still there.
Potentially. Maybe they see the GDP dip as temporary, a blip caused by those imports or weaker government spend. They might be prioritizing that immediate positive data.
So kind of overlooking the slowdown signal from the GDP.
Or perhaps interpreting it differently. Maybe it suggests companies are hiring, but demand isn't quite there yet to boost overall output in the same way. Or inventories are building up. Unusual.
Interesting. Okay, let's hop across the pond to the Eurozone. Different story there.
A bit, yeah. They actually saw GDP growth speed up in the first quarter.
Hit 0.4%, right? Double the last quarter.
Exactly. Spain looks strong, Italy too, and even France and Germany got back into positive territory.
Sounds pretty good. A positive step.
It is, on the face of it. But connect that to inflation.
Always the caveat.
Well, headline CPI ticked up a bit, 2.2%. But the core number, stripping out food and energy, that went up more. Yeah, up to 2.7%. And that's tricky for the European Central Bank, the ECB. Makes their policy decisions more complicated.
And there's another layer too, right? This growth is happening while economic confidence is falling.
Precisely. The EC's index dropped to a 4-month low. Consumers are feeling more pessimistic.
So the economy grows, but people feel worse about the future.
Yeah.
Weird.
It raises that question, doesn't it? How sustainable is this growth? If sentiment is weakening and that underlying inflation is proving sticky, suggests maybe some fragility under the surface.
Right. Okay, let's pivot to the UK. Their stock market, the FTSE 100, actually did okay last week. Made some gains.
It did, yeah. But the domestic signs are less encouraging.
Like the housing market. Seeing reports it's cooling off.
Definitely. Nationwide's price index dipped in April, and mortgage approvals fell again.
That's 3 months in a row now.
3 months straight. And it's not just housing. Business confidence took a big hit, too.
Lloyd's barometer.
Yeah, fell 10 points. Down to 39%, lowest since January.
Wow. And what are they blaming?
Concerns about potential tariffs, again, and rising labor costs. That seems to be weighing on businesses. A real shift in mood.
So FTSE up, but housing and business confidence down. Could the UK recovery be losing steam here?
It certainly looks like the momentum might be fading. You know, when a key sector like housing slows and business sentiment drops sharply, it suggests the path ahead might be getting tougher.
Makes sense. Okay, let's look east. Japan, their markets were up too.
Nikkei and Topopix gained. mostly driven by expectations the Bank of Japan wouldn't tighten policy.
And they were right. The BOJ held rates at 0.50%.
They did. And importantly, alongside that, they actually lowered their forecasts for growth and inflation all the way out to 2026.
So a more cautious outlook from the central bank itself.
Exactly. Which probably reassured markets that easy money wasn't going away soon. That helped the positive mood.
But what about the actual Japanese economy? The data coming out, not so great.
No, not really. Manufacturing PMI contracted in April, and the March numbers for retail sales and industrial production were, well, underwhelming, below expectations.
And the yen weakened off the back of that, right? Against the dollar.
Yeah, JPY 144.7. Because if rate hikes are further off, the currency becomes less attractive.
So the market likes the easy policy promise, but the domestic economy looks like it's stalling a bit. How does the BOJ play this?
It's a tricky balance. They're being cautious, clearly, given global uncertainty. But you have to wonder how long that cautious stance works if domestic momentum keeps fading. Policy can only diverge from the real economy for so long.
True. Okay, last stop on our regional tour, China. Mixed performance there, holiday-shortened week.
Right. Hong Kong's Hang Seng did okay, moved up. But the mainland indexes, Shanghai and CSI 300, dipped a bit.
But there was some talk, maybe some hints of a thaw in U.S.-China trade relations?
Yes, some signals about potentially resuming talks, maybe even some tariff exemptions being evaluated. Definitely something to watch. Potential positive.
But offsetting that, perhaps, was the domestic data again. Manufacturing PMI looked weak.
It did, yeah. Dropped to 49 in April. That's the lowest since December 2023. And services PMI softened too.
So growth pressures seem to be building. Are we expecting stimulus? Beijing usually steps in.
There's definitely anticipation of stimulus.
Yeah.
Lots of talk about needing support to hit that 5% growth target. But we haven't seen concrete major actions yet.
Feels like they're being careful.
It seems that way. So while better trade relations would help, meeting that ambitious 5% target looks like a challenge without more substantial domestic support, given the latest data.
Okay, whew, that's a lot to digest across the globe. Let's shift gears now and look ahead. The coming week, May 5th to May 9th. Calendar looks busy.
It certainly does.
Let's start with the U.S. Monday, we've got ISM non-manufacturing. Tuesday, trade balance.
Then Wednesday's the big one, Fed rate decision, and crucially, Powell's press conference.
Right. Then Thursday, productivity and labor costs, weekly jobless claims. Friday wraps up with wholesale inventories.
Lots happening stateside.
What about Europe? Bit quieter early on.
Yeah, May Day holidays impact things Monday, maybe Tuesday in some places. The main event is probably the ECB's economic bulletin on Thursday. Gives us their latest thinking.
And German factory orders on Friday.
Yep, a key indicator for their manufacturing health.
Japan's got holidays too, right? Golden Week.
That's right. Markets closed Monday to Wednesday. We get final services PMI Thursday, then Friday's important. Household spending and labor cash earnings. Key domestic demand clues.
And China, coming back online midweek.
Markets reopen Wednesday after their Labor Day break. Not expecting any major data releases on Friday, though.
Okay, so a packed schedule. If you had to pick the absolute highlights, the things everyone should be laser focused on this week, what are they?
Number one, no question, is the Fed meeting on Wednesday.
Even though no rate change is expected.
Exactly. The decision itself is almost a foregone conclusion. It's all about Jerome Powell's tone in that press conference.
What signals is he sending about summer rate cuts?
Precisely. How hard does he push back against market hopes? Or does he leave the door open? Any hint of a more hawkish stance than expected could really move markets. Equities, yields, the dollar. It's critical.
Okay, Fed meeting, top of list. What else?
I keep a close eye on China as things reopen post-holiday. Any early signals on trade, on credit activity, that could tell us a lot about whether stronger stimulus is becoming more likely.
So watching for signs of intervention.
Or signs that make intervention more necessary, yes.
Yeah.
And then in Europe, that ECB commentary on Thursday, after the April inflation numbers held up.
Especially core inflation.
Right.
Yeah.
How do they frame that? What does it mean for their policy path? That'll be closely watched.
Got it. Okay, busy week. Let's boil it down further. Top 5 risks we should be tracking, May 5th to 9th. What's risk number 1?
For me, it's that U.S. Fed hawk dove tilt. The risk is Powell sounds more hawkish than priced in on Wednesday. That could spark an equity pullback, push yields higher. Key event, Wednesday's Fed decision and presser.
Makes sense. Risk number 2?
I'm watching U.S. productivity versus cost pressures. The data comes out Thursday. If productivity stays weak while labor costs rise.
That spells inflation trouble. Undermines the soft landing story.
Exactly. It points to stickier inflation pressure. So Thursday's Q1 productivity and labor cost report is key there.
Okay, number 3 on the risk list.
Heading back to Europe. Eurozone stagflation concerns. You've got that higher core inflation, but also weakening sentiment.
Tricky mix.
Very. It could force the ECB to delay rate cuts, which wouldn't be great news for European stocks. So watch the ECB bulletin Thursday and those German factory orders Friday.
Risk number 4.
Back to Asia. China growth fragility. If the first data points after the holiday trade credit look weak, expect calls for stronger stimulus to get louder.
So watching for informal signals, maybe, from the PBOC or local governments?
Precisely. Early May could bring some hints there.
And your final risk, number 5.
Sticking with Asia, it's a potential Japan demand dip. The BOJ sounded more dovish, but they need domestic demand to hold up for any kind of future policy normalization to work.
So weak household spending could derail things.
It absolutely could. That's why Friday's household spending and labor earnings data is so important this week.
Okay. So wrapping this all up then, it really feels like markets are, I don't know, floating along in some areas.
Yeah.
But underneath, there are these definite signs of fragility, economic weaknesses bubbling up across different regions.
Absolutely. And this week really puts the central banks, the Fed and the ECB, right back in the spotlight.
So much depends on the data, and maybe even more on how they interpret that data for us.
It's incredibly data dependent right now. You really need to track the numbers closely and understand how all these global pieces fit together. It's dynamic, constantly shifting.
Couldn't agree more. So final thought for you listening this week. With all these mixed signals, all these risks we've laid out, which single piece of data coming out this week do you think will be the biggest market mover? And maybe more importantly, why?
Think about those connections. How one piece of data can ripple outwards.
Definitely something to chew on. Thanks for taking the deep dive with us again.
We'll see you next week.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.